we have to commend the management team at the Evander Underground for a much better performance. That infrastructure is now fully commissioned and operating as it should. But with higher grades, we can expect certainly even an even better performance as far as the Evander Underground is concerned.
Hello, you're watching Proactive. I'm joined by Pan African Resources CEO Cobus Loots. Cobus, very good to speak with you. You're on with the first half operational update this week. Group production up 51%. What were the biggest drivers behind that step change?
Well, certainly Elikhulu delivered ahead of expectations that assisted us, but then also the fact that we commissioned Tennant in Australia, number one, and secondly, the very successful MTR project on the west end of Johannesburg also produced for a full period. So that definitely set us up quite nicely for the first half. But as we guided in the release, we're expecting an even better performance in H2.
Evander really stood out during the period as well. How sustainable is that performance as you move into H2?
Well, we actually would hope to do even better at Evander. And as we said in the release, we have to commend the management team at the Evander Underground for a much better performance. That infrastructure is now fully commissioned and operating as it should. But with higher grades, we can expect certainly even an even better performance as far as the Evander Underground is concerned. So that's very encouraging.
And of course, the gold price has really been on your side this year, helping you cut net debt by more than 65%. You've proposed an interim dividend. How do you balance growth, returns, and staying conservative, Cobus?
Yeah, so gold price is excellent, I have to say, and it has allowed us to de-gear. And we've said that by the end of February, we should have pretty much no debt on a net basis. So I think Pan African's always been quite successful in terms of balancing all of the calls for capital. We'd like to think we pretty much sector leading as far as our dividend is concerned, and then we've managed to obviously reinvest into the future of our business, but then also managed to grow very successfully. Was the two most recent examples being MTR, which commissioned ahead of schedule below budget, and then also our venture in Australia, Tennant, which was commissioned last year. So we'd like to think we will continue to be able to strike a very good balance between all of the different calls on capital.
Costs were a bit higher than planned. What gives you confidence unit costs will come down in the second half?
Well, the costs were higher generally because of external factors outside of our control, and we explained those also quite in quite a bit of detail. The rand is stronger, and that impacted our US dollar costs. Also, there was some once-off share option costs that was included. So, yeah, those were, I believe, outside of our control. On an absolute basis, costs are very well controlled. And if we manage to increase production, like we've guided that we should be able to do in H2, from a unit perspective, that should definitely benefit the all-in sustaining costs. Obviously, we don't control the rand and we don't control the share price.
Of course. How important are projects like the Soweto Tailings and Tennant mines to the next phase of growth, Cobus?
Well, Soweto for us is very exciting growth. A definitive study will be complete by June, and then we'll make a final call as to whether to proceed. But obviously, I mean, if it's anywhere close to the economics of MTR, it would be a very compelling call or investment for the group. And then we're very excited about the prospects for Australia. We expect production in H2 to pretty much double. And then we've had some very good exploration success also at Tennant. So yes, I mean, it's a very interesting gold field from which we can expect many years of production into the future.
And of course, with gold at current levels, Cobus, it must change your production and development profile and obviously make decisions like Soweto Tailings easier.
It does, but I mean, we've always been very conservative in terms of our planning. So we would not use the current gold price. I mean, there's lots of discussion as to how sustainable it is. It does look like it has a lot of momentum, but it wouldn't be the sort of price we would plug into our models. MTR, we modeled a much lower gold price, and we still got a payback of sort of 3 years from a model perspective. Obviously, now it's been accelerated massively by the gold price. But Soweto will be a low-cost, long-life operation. compelling at much lower gold prices. And that's really the sort of project you want to be investing in our view.
Cobus, I hope you continue to keep us updated with your progress. Thank you very much for your time today.
Thank you for having us.
Cobus Loots, the CEO of Pan African Resources.